All right, let's talk about the mystery charts and the methodology and action. Let me just do this just in case. Anyway, here's the mystery chart reveal, and this is dash. Now, this was a short, and you can see the parameters down here in the spreadsheet. By the way, if you want to look at these, the newer ones are now on YouTube, youtube.com/Dave Landry, and there's a playlist for the core trading service. And also another, by the way, if English is not your native language, YouTube has a pretty decent, even with my bad kunas, but YouTube has a decent AI translate. It's pretty good, especially if you know a little bit of English to begin with, which I'm assuming you probably do anyway. But anyway, if English is not your native language, don't sweat it. The translation, again, is pretty good. And obviously, the numbers are universal. But that was the parameters down below. And this was a bow tie. It was also a first thrust type of setup. Entry was here. The initial profit target was down here, and the stop was up here. Now, this was shown last week, and since then, it's had a pretty decent rally. I decided to take it off as a potential setup and replace it with two new setups, which we'll get to in just 1 second. So in this case, no capital was put into harm's way. As I say ad nauseum, I'm often shocked at how many times waiting for entries can keep you out of trouble. And I hate to retell the story, but many times people say, Dave, what should I do with that turd you recommended 6 months ago? You know, I'm like, I wouldn't recommend this stock. It's going straight down. It's like, yeah, you did 6 months ago. And lo and behold, I did, but it never triggered. So maybe somebody's going to ask me about Dash when it's at $500 a share and they shorted it at 178. Here's another mystery chart reveal. This is BRBR, and the parameters once again are down below. Notice that it made kind of a classical TA pattern, kind of a double top, as you can see, and certainly at the least it wasn't making much forward progress. And then of course you had a bow tie to the downside, and the bow ties are illustrated down here. Green means that 10 simple is greater than 20 exponential, and 20 exponential is greater than 30 exponential. This is a pretty good little metric to keep you on the right side of the market. And at the least, as I often say, I see indicators more as illustrators. They help to illustrate what's already in the chart, okay? So obviously we had a nice uptrend over here, and that's also evidenced by the Landry light. Market started getting iffy and choppy and sideways. I'm sorry, Landry light, but also the bow ties. Notice that the bow ties started meandering back and forth, red to green to yellow. Yellow means they're not in uptrend proper order or downtrend proper order. It means they're just going back and forth like that, as you can see in here, kind of chopping around. Anyway, the market pulls back a little bit to complete the pattern. Entry was here, stop was up here, and initial profit target was down here. And you can see this was shown last week. I think that's this day here. And it's pretty much gone straight up since. And once again, no capital is put into harm's way. Thank goodness. Now, here's the mystery chart for the week. And your parameters are down here, 7150, 8150, 6150. That would be the entry, protective stop, and an initial profit target, respectively. Notice that, obviously, looking at the bow tie proper order, this thing was in a really nice trend for a long time. Did a little bit of what some people call a squeeze back here in the moving averages. That's kind of a cool little thing. Maybe a little fodder for research, okay? But I just look at them as like a pullback or whatever. And then you can see it did begin to roll over, going from uptrend proper order to downtrend proper order. It wasn't a super tight one. It didn't go from one day to the next. It took a couple of days to make the transition, but that's okay. And then you can see the bow tie is here. It's a little sloppy, but not too bad. And it is coming off all-time highs. So you can see first thrust to the downside, also a bow tie. It's pulled back a little bit. Entry is here. Stop is up here. Now keep in mind, this was recommended a few days ago when it was much higher. So it did have a little bit more wiggle room to the chart. Mouse. There it is. Anyway, initial profit target is down here. So we'll see if it triggers. We'll see what happens, and I'll follow up with it. Now, this one is not a mystery chart because it did trigger this morning before I had a chance to show it as a mystery chart. And there are your parameters down below. I think it's still a pretty good looking setup if you didn't take it already. College fund worthy, right? No, I'm joking. Anyway, it did make a kind of a marginal double top, and at the least, it lost momentum by failing to make new all-time highs. And you can see the bow tie came together here, and that's where the moving averages come together and look like a bow tie, right? And if it does it fairly quickly without a whole lot of yellow, meaning that they go from uptrend, proper order to downtrend really quickly, 10 greater than 20, 20 greater than 30 to 10 less than 20 and 20 less than 30 over like a 1 day period, then you have no yellow. If it takes a couple of days, obviously you have a little yellow in between because it's neither uptrend nor downtrend proper order. And you also notice, again, these indicators really don't indicate anything. They help illustrate what's already in the chart. You had a pretty serious thrust down followed by a retrace. Entry was here. Again, it triggered a little while ago. I bought 145 puts. So we'll see how that shakes out. Initial profit target down here, stop is up here, and whatever those parameters were, right around 160. Now here's a mystery chart follow-up. And you can see this is in the live portfolio. The initial profit target has been hit. Remember, it's 2% based on a hypothetical 100K account, which you can't see the number in here, but it's a 100K is what I have this set to. Keep the math easy. It does not go up and down with a profitable or losing trade, respectively. I just keep it at 100K to keep the math easy. So you can see bow tie came together there, shifting from, again, uptrend proper order to downtrend proper order. Even if you were paying attention to the uptrend proper order, notice that we went from green to yellow and back to green, but notice that it didn't make a whole lot of progress in that over that time. So it was at 27-ish in February and way back in early December, it was also at 27. So at the least, it's lost momentum. So again, not to beat the dead horse, always look at the charts, no matter what your indicators are saying. Anyway, the pullback was there, entry was there, stop was up here, initial profit target was down there. We did hit the initial profit target. When that happens, obviously, we bring that stop down to break even. And now we have what Charlie Kirk has named a free roll. So worst case scenario, barring overnight gaps, and I know gaps can happen, right? But worst case scenario, barring overnight gaps, you scratch out on the remainder of the shares, and at least you make a little bit on the trade. And there's a potential for a home run now that you have that free roll or that free position, so to speak. Let's talk a little bit about trading and timing with the VIX. Now, I spent a lot of time in this last week, so I just kind of want to give you the gist of it this week. If you can't sleep at night, go in and watch last week's presentation, borrowing a line from Greg Morris. Just don't operate heavy machinery afterwards, right? But anyway, the VIX tends to get stretched one way or the other. And VIX is a measurement of volatility. It's a measurement of how expensive, so to speak, the option prices are. And when the options prices get super duper expensive, the market is due to rally because there's such a panic mode in the market, and those premiums come off really quick and the VIX begins to implode. And the converse is true too. When it gets stretched to the downside and the options are really cheap, it suggests that there's complacency in the market. So kind of look at the 10% above or below the 10-day simple moving average as, I got a dog monitor here, I turn off. She just found us, my wife just got home and she found a squeaky toy. That'd have been interesting. Anyway, so when it gets stretched one way or the other, and 10% is a good round number, and just to let you know where this is coming from, in the mid 90s to later 90s, I did some work with Larry Connors, and he was a big fan of the VIX, and he turned me on to a lot of this VIX type trading, and I was able to do research for him and then come up with some systems on my own, which I gave to him, or I should say we shared. But anyway, 10% is a good round number. The green line here is the high. If you squint your eyes, you can see the formulas underneath, okay, which is relative to the 10-day simple moving average. which I have here as this reddish light or line, or what do you call that, magenta maybe? And then this is the S&P 500 in the background, and this is the VIX, obviously. And the 10-day symbol works pretty good. Larry explained to me that it's a reversion to the mean type of market. So I took what he said literally and used the mean, or used the moving average as the mean. And when it got stretched 10% or more away, I found that it's a good time to look for reversals. Now, one thing that I find interesting, and I haven't done enough of it, but I probably should just sit around and wait for this, okay? Wait for the high of that VIX to get something ridiculous, like 100% away from that moving average, and then look to act. Now, keep in mind, I'm gonna touch upon this again in just a second, but keep in mind that the VIX does not act like a stock because you're measuring volatility. It's a completely different animal. And one thing that Connor's explained to me is volatility tends to overshoot itself. When it gets really low, it tends to take off, and when it gets really high, it tends to implode. And we could use that to our advantage. I went on this grail hunt for a long time on volatility. I didn't find the grail, but I learned a lot in the process. But anyway, that's the high, the low, and the close percent away from the moving average. The short-term VIX systems that I published, they were published at Dave Landry on swing trading, such as the CBR3 modified, okay? Those short-term systems are made to get you in the market for a short-term trade. You get in when the VIX is stretched, the beginning to revert back to the mean, and you get out when it hits the moving average. They absolutely print money, these systems, okay? But of course, there's a caveat. They print money until the market kind of comes unglued, like for instance, during the COVID, and I remember the COVID sell-off. I remember going back and doing some VIX research. I'm like, oh my God, why don't I spend more time on this VIX thing, okay? Because it was absolutely printing money with short-term systems. But then when I got to COVID, it kind of blew up a little bit, and they probably work fairly well since. But anyway, even though the short-term systems, I'm not a huge fan of short-term systems, by the way. Pure swing trading, I like to hold on to a piece like you saw with that CCL, because that's where the real money is in that second loaf. And I know I beat the dead horse and all these things, but it's something that I live, or at least try to make sure I live on a daily basis. But anyway, I think there's some use for the highs and the lows in the VIX, but everything in general is based on the close. And again, when you have these spikes, you want to look for a reversion to the mean, like right here again, like we talked about last week, back in August. And as far as trading them, I kind of alluded to this a second ago. Two things. One, the short-term systems can tell you when you're due for a reversal, okay? And that's pretty good information in and of itself, okay? You don't want to rush out and trade it mechanically on a short-term basis. But the other thing that I think is of use is when you're stretched one way or the other, look for a reversal. And I'll show you what just happened recently in the market. And I talked a lot about that to my Facebook group and to my peeps on the service. And then I even put out a couple of tweets on the same thing. But notice that the intraday VIX spiked on this particular day. And again, maybe there's a play you can do with that. And then maybe you can look for some sort of bounce play in the overall market. But you can see the August low happened after that spike. And notice that even the close of the VIX, which is pretty amazing here, 100 and something percent. And it would be fun, I know you want to party with me, but go back in history and look at all of these spikes when they're absolutely extreme like that. Now, I don't recommend catching a falling knife in the markets, but when it gets that crazy, you know you're due for a reversal. Anyway, this is the one I've been talking about recently. We did stretch to the downside here, and I was looking for a reversal, and yesterday's reversal was one that I found interesting, and I thought it was worth a stab. And I took a minuscule position in SPXS, and I actually did like S&P futures on that, but not just a very small amount, and played that. And it's something that I don't want to try to do every day, but with the market stretched like that, it's kind of, it could be a little bit of a gift horse. And the other thing too is, and years ago I worked with a trader who would trade on a day trade, and he'd only be in for a few minutes. but he would look at weekly charts, he would look at daily charts, and he would put everything behind him and then look for an intraday entry. So when you're trading something like yesterday's sell-off, this day here, you've got a little wind at your back, so to speak, because you know the market's in a downtrend and you know it's overbought and it's uptrend. In other words, a pullback, and it's due to revert back to the mean, both in the VIX and the overall market. You can see that's what's happened over the last couple of days. We reverted back to the mean. Now, I put this in last minute, and I did a little research here yesterday, and I didn't find anything conclusive other than I think this could be something useful, possibly when combined with something else. So all I'm doing here is I'm looking at 10-day Landry light, meaning that the lows are greater than the moving average. And maybe 10-day is not the perfect moving average for this. I just thought 10-day for those VIX systems made a lot of sense because that's a 2-week time window, 10 trading days, right? But anyway, I think there's definitely something here. And as usual, you want to pay attention to the chart. So if the VIX is chopping around its mean or moving average, so to speak, then there's nothing to be done, at least vis-a-vis the VIX, right? But if it gets kind of extreme like this, when it begins to pull away from that moving average, okay, and you've got lots of Landry light, meaning the lows are greater than the moving average. And again, as I say ad nauseum, this just counts the number of bars that are above the moving average. So this would be bar 1 here, bar 2, bar 3, bar 4. And you can see it got up to 14 to 15 right around here. And I think if you maybe combine the Landry light with something like the stretched indicator, there might be something worthwhile. I have no idea what happened here, but you can see the market, the VIX at least in this particular case, imploded, and you had lots of Landry light, and then you had to pop back into the moving average. So this might be something to use in combination. So if anybody messes around with this, let me know what you find, and I'll be happy to share it with other people if you want to share it, of course. And you can see recently we sort of stretched to the downside based on this metric, but we already had a bit of that reversion to the mean move yesterday and earlier today, at least. So anyway, if you're, and I hadn't fleshed out the metric, but let's say 10 bars of Landry light, whatever the case may be, above the moving average, then it might be worth looking into. Now back here, obviously, you can just eyeball this, and even though it's only a few days of Landry light, you can see down below, you can count them 1, 2, 3. Okay, see 1, 2, 3 right here. I wouldn't use the Landry light as a measurement, but I would say, okay, wait a minute, that's that August spike that we talked about. This thing is what, 200% away from the moving average, and it closed 100% away from the moving average, so there's something there. So in and of itself, I don't know if there's something here. I would love to know if anybody would spend some time working on this. I just want to throw that out there as fodder for research. Leave a comment below if you're on YouTube watching the recording, and I'll be happy to address it and see if I could help you flesh it out a little further. I threw this last little bullet in here last minute, or first little bullet, I should say. Treat it again as a reversion to the mean. I want to make sure I got that point in. I see people draw like a head and shoulders top and a head and shoulders bottom, or double bottom, double top. I might have some relevance, but for me to wrap my head around something, and I learned this from Connors many years ago, it has to be conceptually correct. So as a volatility-based market, I don't think that makes a whole lot of sense to use a classical TA. But treating it as a reversion to the mean market, something I'm not a big fan of when it comes to trading in general, okay? Like, you don't rush in and buy a market just because it's imploding, because it's due to stop imploding, right? But with volatility, that's sort of how it works. Now, you don't want to be a hero. What you want to do is you want to wait for that reversion to occur and then step in. And it only matters what it matters. And that's where I think the Landry light, and that's why I threw that slide in last minute too. And that's why I was a few minutes late, one of the reasons, that and the light breaking. But I think that paying attention to that Landry light can help you recognize when you're just chopping around that moving average and you might not want to trade it, okay? And high or low, again, is relative. I mean, maybe there's a reason to talk about this, but I see a lot of people who are, well, a lot more famous than I am, talking about the absolute level of the VIX. And I think that's irrelevant for the most part. I don't understand why they do that. I mean, I get it. It's like, okay, we made a volatility shift from this level to this level, and this is the new norm. I'm okay with that. But when they talk about absolute numbers, I think that's problematic. And as I said before Larry did all this other VIX research, before we worked together, I should say, he had a VIX system which was plus, which if you were above 15, you did one thing, or below 15, you did another. And that probably worked for a long time, but that all becomes relative. I think since then the VIX went down, and 10 became the norm for a while. And right now, I don't know what the norm is for the VIX, so it might be shifting. So that high or low, again, is relative. And as I said a second ago, don't be a hero, wait for the reversion to occur. And you could keep in mind that you got to really be careful. You have to really be careful with these VIX ETFs, because they're off futures, and that could open up a whole another can of worms, right? It gets really complicated really fast. But what I would encourage you to do is possibly use those on an intraday type of basis. But I wouldn't hold these things overnight. And again, that's what I'm saying here. Don't short-term position trade. Maybe take intraday trades only. Although major bottoms can start with a VIX spike. So it's a good thing to possibly use bigger picture with your analysis, but I wouldn't position trade off of a bigger picture. But it's like, okay, you're looking for that bottom in the market, and you're not going to catch the falling knife, right? But you're looking for signs that it might be bottoming, not to act on, but just to kind of wrap your head around where we are. And you get that huge spike like we had in August, and the VIX is like, aha, this looks like a washout. We might be done for now, okay? And then follow up with a bow tie or whatever, first thrust, or some sort of other pattern that would suggest that a transition is in place. And if you're really short-term oriented, maybe look at like an hourly or even a 30-minute bow tie or whatever. And then again, maybe look to trade intraday. It's a really good gauge for overbought or oversold, and I find it especially good for a market that's really oversold, because you get that big spike in the VIX higher. Whereas if you're just kind of grinding along, you know, kind of like the little, remember the little, what's the little man, the little mountain man in Price is Right, you know, just kind of going up like that. And that VIX will just kind of drift lower for a while. And that's a little harder to time off when it does that. But when it starts swinging back and forth like it has been now, I think it's a lot more relevant. And, you know, maybe I should make a mental note to myself. I'm preaching to you, leave it alone unless it's really stretched. And that's probably something I need to make sure that I'm doing too. All right, real quick, I know I beat the dead horse in the TFM 10% system, but I think it's important to show you where we are now, because it's still long. And those are all the buys and sells. And we had a buy back in last November. No, 23, November 23. And that signal's still long. And as I showed last week, I actually took 100 shares on kind of an S&G thing, and it turned into one of my biggest trades of the year. But I took, percentage-wise at least, I took 100 shares, I think it was back in May of 2023. And I just got out of that recently. See last week's webinar on that. And the point there is that trend following is phenomenal when it works. Now, when it works is the key thing. If it always works, you never see my fat ass again. Unfortunately, the markets would not exist if it always works. So the reason a lot of this works is because it doesn't always work. And hopefully that makes some sense. But anyway, the sell signal would be when you drop 10% or more away from the 50-week closing high. So right here on that day there, or that week there, you were at 100% of the 50-week closing high. You were making brand new closing highs. And then obviously we sold off from there. Now, without going into a lot of details, the bottom line is this system's intent, or the designer's intent here, was to create something to help you avoid the diaper change moments, as Ian McActivey calls them, when the market just absolutely implodes. And my thinking is, if a market, this is TA 101, right? If a market's going to go from A to B to C and B is somewhere in between, it's going to have to pass through B. So the B point to the downside here is 10% and below the 50-week closing moving average. Okay, that's the whipsaw filter, so to speak. And on the upside, we have a Landry light for the whipsaw filter. Again, I'm rushing through this just because I know everyone here that's attending live, for the most part, knows the system, and they're probably, their eyes are glazing over. I can see my numbers dropping, so I need to get do something exciting here. Now, I just want to spend a couple of minutes on the Landry 100 this week. This is not real money on this, although I did do some real money trades for S&Gs, and of course, I started that as an experiment right as we were going into this bear cycle or bear move that we just had. I don't want to label it and get in trouble, but it's kind of bearish out there. And all of these are bought at brand new highs. Now, the closed trades have gone really negative on this, the trades that I've taken out of this list. And keep in mind that this is like a constant window dressing. Every day I come in, I take out crappy stocks, and then I put in new hot stocks. And it's a wonderful exercise, and I don't have real-time tracking on this. So somebody, again, as I preach each week, if you have some software, I haven't looked into it, but if you have some software that does real-time tracking, that'd be really cool on a portfolio this size and all. But these are all bought at brand new highs, okay? So this one's up 94%, and the buy was right there. If you squint your eyes, you can see that's a brand new closing high. Kind of a stealthy thing. I learned about closing highs from the aforementioned trader who was the day trader, and that's something that he paid a lot of attention to, because a new closing high can be a little stealthy sometimes. It doesn't have the fanfare of a big old breakout or whatever, but you have this little quiet closing high, and that's one thing that I use with the buy at B pattern and the IPOs. And if you get really bored, go in and watch last week's presentation once again. That would be 320.25, and that's where I talked about the buy at B pattern. Anyway, this has had a pretty good run so far, and the reason I'm showing you these, and I'm not bragging on the performance here because I'd be willing to bet it's not fantastic if I added it all up. Again, the only way I have to track it is by the ones I've taken out. And of course, I'm taking out the worst first. So those numbers are pretty ugly. I'm not taking out something that's up 100% just off of all-time highs, right? But anyway, one of the many valuable things that comes from this is it does help you to see where the money is flowing. Like I said last week, we had a bunch of golds, and now we have even more. And at the bottom of this list, because they're listed as an ETF, there's a couple of physical gold stocks that I put in here. And then right here, these are metals, and some of these, like this NAC I just showed, I think that's mostly silver. It's something metal, right? And anyway, it's kind of interesting that they're all labeled industrial, but they're industrial metals and minerals, and each one might have gold, they might have some copper in here, and they might have some silver. By the way, I'm just noticing this by accident. I didn't realize I had Berkshire Hathaway in here. I wouldn't even paid attention when I added that. So I'm just trying to be a good little trend following moron, and that's kind of interesting because when the market sells off, these value stocks tend to do a little bit better. Can never remember his name, and I always have to look it up. But I saw him speak once at a I think it was in San Francisco, maybe 15 years ago or 10 years ago when I was speaking also. And he's from the NASDAQ. I can see his face and everything. For some reason, his name always escapes me. But he talked about how value becomes momentum and momentum becomes value. Okay. And if you're kind of looking at this now, you can see, well, these golds or whatever, they're kind of more value stocks, and they're becoming momentum, okay? And then all your momentum stocks, your mags and all that, they're becoming value because they're getting cheaper, cheaper, cheaper. Now, if you want to buy them, but they're becoming more of a value type of stock than a momentum stock. Now, he said something that made a lot of sense. If you never want to make any money, buy a mutual fund that does half value and half momentum, because one's going to be going down while the other one's going up. But anyway, I didn't mean to back into all that, but that's a really good way are just another one of these things that kind of teach you about markets and show you money flows, is paying attention to these Landry 100 stocks. And you can create your own. The formula is super simple. I'm just putting stocks in here that are making a new 52-week closing high for now. And surprisingly, I found enough to keep the lists full. Now, if this move lower, I hate to say bear move, but for lack of a better word, this bear move lower persists, then I would imagine I might have to drop down to 90-day or maybe even lower highs. And that's what I did years ago to try to find more for this list. Now, keep in mind, and I think I have 99 in this, it's hard for me to see, but cash is an asset class. So if these things start stopping out and I can't find new ones, I'll just leave a slot, so to speak, for cash, okay? Just some random thoughts, as I've said before, and I'll just go through them quickly. Momentum does end badly, unfortunately. As I said last week, relative strength in a bear market is okay, especially if you're going after something like gold. But don't just buy a drug stock, as I'll show you in a minute, because drugs are doing better than the rest of the market. It's kind of like rats leaving a ship. The ship's sinking, right, and all the rats run to the top. And, just because they're higher than the rest of the boat or whatever, doesn't mean that they're not going to eventually sink. The one exception would be possibly commodity-related stocks, obviously. But it's a great way, as I've said, to see money flows. And this is left over from last week. This is the one I want to show you. So Abbott Labs, and I took it out at a loss, but you can see it was making all-time highs. So I'm like, okay, well, let's throw this in the list. And then it imploded, and the market, it caught up to the market. Or I guess another way of looking at it is the market caught up to it.